Hi guys, if you have never invested before and you are after a super easy beginner-friendly video to help you explore some of your investing options, then this video is for you. I'm going to show you 10 simple ways to invest $1,000 and I will walk you through each option step by step so that you will be able to start putting your hard-earned money to work after this video. If you're new here, hello and welcome. My name is Jumoke and I am an investment banker turned early retiree. On this channel, I share some of the strategies that I applied to manage millions of dollars for some of my ultra wealthy clients. I also talk about personal finance, investing, wealth creation, as well as self-improvement. If that sounds interesting to you, do not forget to click on the subscribe button if you aren't already subscribed. Hit the notification bell so you don't miss any of my new videos. Let's dive right in. The first way to invest your $1,000 is to invest in index funds. An index fund is a type of investment that aims to replicate the performance of a particular stock market index. So for example, one of the most well-known indices is the S&P 500, which is an index of the largest 500 companies or corporations in the USA. So instead of buying shares in 500 individual companies, you can buy one index fund that tracks the performance of the S&P 500. And so that way you become a part owner in 500 companies. That's pretty neat. And so if you wanted to know how well the stock market in the US is performing, instead of looking up 500 individual companies to take an average of their performance, all you need to do is look at the S&P 500's performance from the start of the year to today to see how well it's performed. And you can do this by looking up something called the year-to-date performance. Although there are a lot more stocks than 500 stocks in the USA, runs into thousands, the S&P 500 is widely accepted as a pretty good proxy for how the stock market in the USA is performing. And this is because this index contains the largest 500 companies in the US. Now, there are many index funds out there that track different markets, different regions, and different sectors. For example, the FTSE 100 index in the UK, the Nikkei in Japan, the CAC 40 in France, and so on. So to clarify, you cannot buy the S&P 500, and that's because it's an index. Instead, you can buy a fund that tracks the S&P 500. And so what this means is that if the index was to rise by 6%, your investment will rise by the same amount. If the index was to fall by 6%, unfortunately, your investment also sees a decline of 6%. Now, there are 4 things you should know about index funds, and these can be seen also as good reasons to invest in index funds. Number 1 is passive investing. If you are only looking to partake in the performance of the market, then an index fund is a great way to go. It follows a passive investment strategy, which means that it's not trying to beat the market, it just matches it. Number 2 is a diversified portfolio. The second thing about index funds is that you get the advantage of safety in numbers, because you don't have to know or be an expert at picking stocks. By buying an index fund, you automatically get access to widely diversified stocks that cover different industries as well as sectors. And so if you're not interested in researching tens or hundreds of stocks, an index fund offers built-in diversification. And this diversification is fantastic because although not all stocks rise over time, the overall market tends to trend upwards over the long term. Number 3 is lower costs. Index funds tend to have lower fees than actively managed funds, and this is because they require less management. Number 4 is long-term growth. Index funds are popular amongst long-term investors, and this is because they offer steady market average returns with less risk. And there is one ultra-famous investor who recently steps down from his role after 55 years, who's a big advocate for index funds. Can you guess who it is? That's right, Warren Buffett. He is a huge fan of index funds and he often advises investors to invest in index funds regardless of market conditions, i.e. whether markets are going higher or whether they're declining. Because in the long run, markets trend higher, which means that your investments will see an increase over time as well. So to buy an index fund, you will need a brokerage or stocks and shares account. Here are 3 examples of S&P 500 index funds to get you started on your research. research: the Schwab S&P 500 Index Fund, the Fidelity 500 Index Fund, and the Vanguard 500 Index Fund. The second way to invest your $1,000 is to invest through an ETF, an exchange traded fund. Now, these are very similar to index funds. Just like index funds, they track an underlying index. But the main difference between the two is how they are traded. Index funds trade once daily at the net asset value, i.e., the price of an index fund is based on the total value of securities within the fund. Whereas with ETFs, they trade throughout the day. You can buy and sell at any time you want throughout the day because they trade like normal stocks. You can also buy as little as 1 unit of an ETF, often with no minimums. But some index funds may have a higher minimum investment amount, like $500 or $1,000. And so just like an index fund, an ETF gives you access to hundreds, maybe even thousands of stocks under one instrument. Some people prefer the flexibility of ETFs over index funds, and this is because they enjoy the ability to trade in and out of their positions at any time of the day. And just like index funds, ETFs are typically passively managed, although you can get actively managed ETFs, which means that the fund managers will make active investment decisions based on market conditions or where they see dislocations or opportunities within the market. So here are two examples of S&P 500 ETFs to get you started on your research: the SPDR, or as we call it, the Spider S&P 500 ETF, and the Vanguard S&P 500 ETF. The third way you can invest your $1,000 is through bonds. A bond is basically a loan that you give to a company or a government. In return, they promise to pay you back later with interest. So think of it like you are the bank and they are borrowing your money. Now, why would you consider investing in bonds? Well, because bonds are often more stable than stocks, i.e., they don't see the same drastic volatility that stock markets tend to experience. And historically, when markets are shaky or choppy or volatile, bonds tend to smooth out that ride a little bit. And plus, they pay you regular interest. So that's kind of a paycheck for your investments. And over time, they tend to be fantastic diversifiers for a portfolio that has a heavy allocation to stocks. They can generate income to help you supplement your salary or even fund your retirement. Bonds have different levels of safeness, and there is what we call investment grade bonds, which are the safest type of bonds you can find. And you also have sub-investment grade bonds, which are lower down the spectrum and are considered more risky. Investment grade bonds, because they are considered less risky, come with lower interest rates, whilst sub-investment grade bonds or non-investment grade bonds, or junk bonds as they are sometimes called, come with higher interest rates because of the risk-reward trade-off. And there are many reasons why a bond could be classed as sub-investment grade. And this could be based on the size of the company or the perceived riskiness of the government issuing the bond. And so to entice or attract investors to hold these instruments, the issuing government or company will tend to offer slightly higher or significantly higher interest rates because of the risks investors take whilst holding these instruments. So how do you buy bonds? Well, similar to index funds and ETFs, you can buy bonds through a brokerage account. And what's more is that if you cannot decide on which bonds to buy, well, you're in luck because there are bond ETFs and bond index funds out there. So here are examples of bond funds and ETFs to get you started on your research: the Fidelity Investment Grade Bond Fund and the Schwab Short-Term US Treasury ETF. The fourth way you can invest your $1,000 is through robo-advisor apps. Imagine you had a personal financial advisor who never sleeps and never judges and charges way less. That's for the most part what a robo-advisor does. A robo-advisor app is an automated investment service. You tell it what your goals are. For example, I would like to buy a new house. I would like to retire at 60. I would like to receive regular income, or I just want to grow my money. And it then builds a portfolio for you using algorithms. Now, there has been a huge rise over the years in this service, and that is to give the masses more access to investing. Back in the day, only the ultra wealthy or the wealthiest families could invest in the stock market. And this was for various reasons, including affordability, minimum investment amounts being so high, as well as physical location. But now investing has been democratized, so anyone can gain access to financial markets. So how does it work? Well, once you've deposited your money, The Robo app takes care of the rest. It will ask you some questions around your financial goals, your time horizon, your age, and basically your investment objectives. It will then create a portfolio based on your answers, which is tailored to your investment needs. And the portfolio it generates is typically diversified through well-rounded, low-cost ETFs that give you great access to a broad array of stocks as well as bonds. And what's more is that the app automatically rebalances your portfolio. And on some platforms, they even harvest any tax losses. Robo-advisor apps are good because of low to no minimum amounts to get started. And so with $1,000, you are definitely good to go. They have super low fees and they offer a hands-off investment service. And it is great for beginners who have no experience in investing and just want it done right. One thing to note about some of these robo apps is that you can't alter your portfolio. So for example, you can't choose to buy individual or single stocks or bonds. You essentially are handing over the reins of decision making within your portfolio in exchange for ease as well as simplicity. And so if you are ready to put your money to work, and you don't want to think too much about it or pay a financial advisor a pretty penny, then you may want to check out robo-advisor app services. So here are some examples of robo-advisor services in the UK as well as the US. Everyone is different, and so our investment journeys will differ one person to the next. And so maybe you aren't quite ready to get started with investments, or you just want somewhere to park your cash that is safer than stocks but offers a higher return than a regular savings account. The fifth way that you can invest your $1,000 is to invest in money market funds. A money market fund is a type of mutual fund that invests in short-term, high-quality debt instruments like government bonds, certificates of deposits, and commercial paper. It's specifically designed to offer stability, i.e. to keep the net asset value close to £1 or dollar per share. It also offers liquidity, i.e. easy access to your funds. And thirdly, it provides income through regular interest earnings. And to give you an idea of current potential earnings, in the US, top money market funds are offering up to 4.89% APR. And in the UK, the average yield for UK money market funds is closer to 4.95%. And whilst someone watching may think, well, 5% isn't good enough for me, it's way too low, believe me, there's always one complainer. I personally think that for where we are today, these are good enough rates because at least you are beating inflation, which is around 2.5% in the US, UK, as well as Europe. So here's how money market funds work. You invest in a fund and it pools your cash alongside those of other investors within the funds to buy short-term debt securities, i.e. you are lending money to short-term borrowers over a 3 to 6 month period. And the interest earned from these short-term loans is distributed to yourself as well as other investors on a daily or monthly basis. Money market funds are beneficial because they invest in number one, high credit quality short-term instruments. Number two, money market funds often offer better returns than your traditional savings accounts. You can usually withdraw your funds fairly quickly without penalties, but of course, this will be on a case-by-case basis, so it's important to read the fine print within the term sheets. And lastly, you get safety in numbers because the fund spreads your risk across different instruments and not just one. And so here are some examples of money market funds to get you started on your research. The Vanguard Sterling Short-Term Money Market Fund if you're in the UK, and the Schwab Prime Advantage Money Fund if you're in the US. Now, you may be interested in the property market, but you don't quite have enough funds to buy a whole property. One great way to get access to the property market without owning real estate physically is the sixth way that you can invest your $1,000, and that is through REITs, real estate investment trusts. Now, this may sound incredibly fancy, but REITs trade the same way as stocks. A REIT is a company that owns, operates, and manages income-generating real estate. Properties like shopping malls, apartment complexes, office space, or even data centers. By law, REITs are required to pay out 90% of their profits to shareholders in way of dividends. And so this means you get a cut of the rent without being a landlord. So how can you buy REITs? Well, similar to how you would buy a normal stock. You would need to open a brokerage account. And what's more is that you can buy individual REITs or you can buy a REIT ETF, very similar to what we discussed earlier, where you have several REITs on the one instrument. And you can do this through brokerage apps like Thinkorswim, Robinhood, Vanguard, Fidelity, or even through your IRA. So here is why REITs are desirable. You receive a steady income through dividends. For example, and this is just an example, let's say a REIT commands a 7% dividend. It means that if you invest $1,000, you will receive on an annual basis $70, which is a nice way to earn dividend income. Also, you get the benefit of diversification because REITs, although they trade like stocks and they pretty much get affected by the same market conditions as stocks, they provide access to a different underlying asset class, which is property. And additionally, you get the benefit of liquidity because you can sell your REITs at any time, just like stocks. So here are a few examples of some REITs to get you started on your research. Public Storage, which has a ticker PSA, Prologis, which has a ticker PLD, and Realty Income, which has a ticker O. The seventh way you can invest your $1,000 is through crowdfunding platforms. Over the last decade or so, there has been an increase in demand or interest from regular investors such as you and I into startup companies, and not just interest from the rich and wealthy. And in the past, most of these deals were reserved exclusively for the ultra wealthy as well as institutional investors. But thanks to the growth in these crowdfunding platforms, for as little as $100 or even less, you too can get access to startup companies that may become the future Airbnb, Google, Amazon, or even Apple. So why is investing in crowdfunding potentially good? Well, you're getting in early. If this startup succeeds, your small stake could grow exponentially. It's also a way to diversify from listed traditional stocks and bonds because you are taking a stake in a new business or company that isn't listed on the stock market. And lastly, you are part of innovation. You're not just funding a company, you are funding a dream. So how can you invest? The first step is to sign on to platforms like Seed Invest, Crowdcube, or Funding Circle. Once you're signed on, the second step is to browse through the startup pitch index or sales pitches. You can read through their business plans, you can look at their financial projections, you can watch videos. And once you find a startup that piques your interest, the third step is to invest as little as $100 on certain platforms to become a shareholder. And so you don't need to be a millionaire to get access to some of these startups. You just need belief and you need a little bit of cash. A word of caution. According to the latest data, 90% of startups fail. And so this is a very, very high risk option, but it's just that. It is an option for those who are risk seekers. So here are some examples of crowdfunding platforms to get your research started. The next way to invest your $1,000 is to overpay on your mortgage or pay down some of your debt. Okay, so this isn't an investment in the typical sense of the word, but hear me out. When you own a home and you reduce the outstanding mortgage on that property, you are adding to your equity. And you're also reducing the interest you pay on that outstanding debt. And it may be a small amount, but every little helps. Or if you opt to pay down some of your debt, you are reducing your stress level and you're also reducing the interest that you have to pay on what's outstanding. And so those interest savings could be used towards your savings or building your future. And so if viewed from a holistic lens, you are still investing and building wealth. You're just doing it in a more indirect manner. The ninth way to invest $1,000 is to start a micro business or a side hustle. Okay, so I know a lot of people get put off when they hear start a business because they think it is long and arduous. And you're right, it is. But don't forget that the big businesses you see around you today were once small businesses themselves. The tools you require are a lot cheaper than they were back then. Access to credit is a lot easier than before. Thanks to the internet, your audience is now global and AI is making scaling up a lot easier than ever before. So do not despise humble beginnings because your small business today could be your full-time freedom tomorrow. And there is a vast array of businesses that you could start. You only need to do some digging to see what takes your fancy. The options are both exciting and truly endless. And starting a business is a good idea because you are investing in yourself. There are no middlemen. There is a potential for incredible returns if things go well. And you're building skills, you're building confidence and long-term income streams. But as with most things in life, there also are downsides. There is no guaranteed return. It takes time, consistency, and resilience. And you wear all the hats: sales, customer service, products. All of that is down to you. And so the success of the business comes down to you. But think about it. If you have a good business idea, which would you rather do when you're in your 80s? Would you rather have no regrets because you started that business, or would you rather have a lot of what ifs? And finally, the 10th way you can invest $1,000. And yes, I'm going to get a lot of flack for this, but I don't mind, because not mentioning this option is similar to a physician not giving their patient all the possible options, because some patients may find it too risky, but then on the other hand, it may be life-changing for others. So the 10th way you can invest $1,000 is to invest in cryptocurrencies. Yes, we went there. You have probably heard the buzz. Is cryptocurrency a hype, or is it the future of money? And there is a lot that can be said for cryptocurrencies. Some people believe and say it is the devil's currency. Others say it is a scam, whilst others say it is a speculative investment asset, which inevitably is the future of money. Regardless of what group you fall into, I'm guessing that you've heard some success stories of individuals who have doubled their monies in a short space of time and made millions. And you may have also heard of individuals who have lost all of their life savings on cryptocurrencies. And whether you think it's a good or a bad option, it is an option. Cryptocurrencies are now being taken seriously and being traded by the same financial institutions that only a few years ago said they would never touch them. So why would you invest in cryptocurrencies? Well, cryptocurrencies do offer high upside potential. Bitcoin went from $1 to over $100,000 in the space of 16 years. Cryptocurrencies are now considered a separate asset class from stocks, shares, hedge funds, private equity, etc. And so they do offer diversification. They are decentralized, which means that you do not need to rely on banks or governments to hold or transfer value. And when you buy certain cryptocurrencies, you are investing in the wider blockchain ecosystem. For example, through platforms like Ethereum, which powers smart contracts, NFTs, i.e. non-fungible tokens, as well as Web3 apps. And getting started is incredibly easy, and maybe it shouldn't be as easy given how volatile these assets are, but there you have it. It's incredibly easy to get started. All you need to do is choose a platform via which you'd like to purchase your cryptocurrencies, platforms such as Kraken or Coinbase. You need to then create an account. To create an account, you would need to go through a verification process where your ID will be checked. And once that's done, you are ready to go. The next thing to do is to transfer your funds from your bank account into your crypto trading account. And for as little as $100, you can get started. You can either store or hold your cryptocurrencies on those exchanges or those platforms, or you can hold it in a hard wallet form. And don't forget to stay and keep your assets safe by using extremely strong passwords, as well as multi-layer authentication processes. And as I mentioned, the top financial institutions in the world are now trading cryptocurrencies as well as derivatives on cryptocurrencies in volumes, which also means that you can now buy a cryptocurrency ETF. I completed a video about this and I will link it here. Now, please lend me your ears, for I promise I shall give it back. A warning: cryptocurrencies come with a lot of risk. They can be extremely volatile and you can see massive swings through the day in double digits. There are unfortunately unscrupulous characters out there who will do anything to get in on your cryptocurrencies, and lost passwords could mean a complete wipeout of your funds. Global laws and tax consequences are still evolving in this sector, which means that investor protection is quite low. Some of these cryptocurrencies are highly speculative, which means they have no real utility. If you can think of at least one of those zero utility coins, it's a very obvious one. If you've been paying attention, comment below. And so it is extremely important, do your research before investing and be prepared to lose all of your investments if things go wrong. On a cheery note, here are 3 cryptocurrencies to get you started on your research: Bitcoin, which is the original and the most well-known digital currency, Ethereum, which powers decentralized apps as well as smart contracts, and Solana, which is a smart, scalable blockchain used in DeFi as well as NFTs. Now, there is a golden thread that runs across all of these options, and you need to ask yourself these important questions. How much risk am I willing to take? What do I want from my investments? Do I want a growth in my capital? Do I want income, or both? What is my time horizon? Am I looking over the short, the medium, or the long term? How much capital do I have beyond my initial $1,000 or pounds to invest? Do I have a regular income so I can keep investing? Here is the bottom line. Your investment journey is going to look very different to everyone else's. And so never compare yourself to anyone else, because there is always a part of that other person's journey that you aren't aware of. And just like that, my dear friends, we have come to the end of another video. I will see you in the next one. Look after yourselves. Bye for now.